Hello, this is the CARES Act and Your Money presentation, and today we're talking about the new fiscal stimulus that was signed into law, and I want to be able to give you examples of how this may help you and your family with financial issues that are related to coronavirus and COVID-19. My name is Melissa Joy. I am a certified financial planner and founder and president of Payroll Planning, where we do wealth management and financial planning for families like yours. So today, let's get started. In our discussion today, we're going to talk about what is the CARES Act, and we're going to make sure to have as much information as possible about how this helps individuals who are working, those who are recently unemployed, help for retirees, and different rules related to the retiree workforce. Also important help to small businesses that also may help keep people employed, as well as other resources, and then financial planning strategies. I've relied heavily on resources from Jeffrey Levine, Jamie Hopkins, Bill Sweet, Kelly Phillips Erb, and the New York Times Your Money section, which is largely has a contributor of Ron Lieber, as well as a qualified team of personal finance experts. And then also have included, my own personal perspective on how this may impact you. So we're trying to get this information to you as quickly as possible. The bill has just been signed into law. It's more than 800 pages long. So all of their resources have been useful in collecting the information for this presentation. Okay, let's get started right off the bat. There are recovery rebates that many Americans, in fact, almost 90% of Americans, or perhaps more, are going to be receiving a check from the federal government. So if you are a single filer, then you need to have an adjusted gross income under $75,000 or $75,000 or lower in order to get the full $1,200. And then it phases out $5 for every $1,000 or $100 more that you have earned. And that's your adjusted gross income. So that's what line you're going to want to look at on a previous tax return. If you're a married couple, your adjusted gross income could be up to $150,000 and then starts phasing out for $2,400. Then each child you have under the age of 16, no limit, is $500 per child. If you are a young adult, someone between ages 17 and 24, you cannot be claimed as a dependent in order to receive this check. But still, many taxpayers are covered. How do they go about figuring out if you qualify? Well, if you have not filed your 2019 taxes, the ones that are going to be due this year were to be due in April and now will be due in July, then they will look at 2018 numbers. If you did go ahead and file your 2019 tax return, then 2019 numbers will apply. And then if you were filing neither because you didn't have enough earned income to need to file a tax return, your Social Security earnings credits will be where the IRS looks to determine if you are eligible. This money is not going to be taxable. Let's say that in 2019 you made too much, but you're going to qualify in 2020. Well, when you file your 2020 tax return, they'll go in and make that up. But of course, that's going to be a long ways from where we are right now. So there's no way to go and kind of claim your money early if you don't have the most recent tax return you filed showing that you have that adjusted gross income. That's a wrinkle for sure. But there isn't clawback if they sent the money to you and incorrectly based on a previous year's tax return. There is differing opinions about how long it's going to take to get these checks out. So the government is saying they will do them as soon as possible. The last time we had one of these, it was 3 months. So that hopefully it will be more quickly than that. And some people think maybe 2 to 3 weeks, especially if you still have a direct deposit account where you've received either tax refunds, or if you're a retiree, you're receiving a direct deposit for Social Security. But if you don't have those direct deposits and you moved or something like that, there may be, again, some challenges. So we'll just have to wait and see. It's a case-by-case basis about how easily that money will be in your hands or in your pocket. Here's a look, because that phase out gets bumped up if you have extra children. So you can see the single filer is the light green line here. And, you know, if single no kids, then you're going to start phasing out right at $75,000. But if you were single and you had kids, it would nudge up in terms of the amount you would be receiving it to $1,700 if you had one kid. And so then that cliff would last a little bit longer. So it just depends on how many kids you have as to when everything gets phased out. You can see for a single filer, if you had no kids and you had an income in the $99,000 range, that would be about where it ends. I do have a calculator for this, and I'll make sure to include it in the notes that are related to this video so that you can calculate it for what you think you may be owed. Another important component of the changes that are occurring with the CARES Act are changes in terms of IRA and 401k distribution and loan rules. So the CARES Act occurred, and with that, they took basically some of the responses that occur when there's a federal emergency, like a natural disaster. So for example, a hurricane comes to Florida, and then there are relaxed distribution rules for a certain portion of the country. And they've renamed those coronavirus-related distributions and expanded them to anyone who can show an impact, loss of work, an adverse financial consideration as it relates to the outbreak of COVID-19. So what are the rules that are changing? First, when it comes to distributions from retirement plans, there's relief from a 10% penalty if you withdraw. So you can take out up to $100,000 in your retirement account without a penalty if you're under age 59 and a half. You don't have to have mandatory withholdings, which are something that is typically required when you do a distribution from a 401k or qualified retirement plan. And then you can pay the money back into your plan over a 3-year period, or you can spread out reporting that income over 3 years as well. Versus just, you might want to choose to pay the income this year if you think your tax rates are going to be lower for this year. And then also 401k loans are more flexible. So you can increase the maximum amount of a 401k loan from $50,000, which is standard, to $100,000. You could borrow up to the full vested balance of your 401k, and your payments don't need to start for up to 1 year. A note, if you already had a 401k loan, it does not appear that your payments will be suspended. So this is just for new loans. And of course, there are significant financial planning challenges when you make decisions to do distributions. So you may be helping your current self, but your future self, your retired self, really needs that money to be saved and invested. So I strongly suggest that you consider all of your choices and options before you decide to do one of these distributions. And a conversation with a financial planner can help you make that decision. Also, this also relates to retirement plans, but it's if you are over age 70 and a half or age 72, depending on your birth date. The rules just changed late last year with the Secure Act, so it just depends who this applies to. But there is no required minimum distribution from your retirement accounts in 2020. Now, many of you will still need your required distributions just because you're used to receiving those funds in order to spend and, have your cash flow in retirement. So if you already took a distribution earlier in the year, you might be able to return it. It just depends on when that distribution was taken. And 2020 is also not counted for 5-year beneficiary distributions to close out accounts. It wipes out that required distribution across the board. So this is really interesting. I think it may actually help people that are less economically challenged versus those who are more, just because, like I said, if you are typically living paycheck to paycheck from your IRA distribution, you're likely not going to want to halt your required distribution. But for others, if you have flexibility, then you can retain some of the assets, and there's also some tax advantages to delaying. So what if you want to help your community? For those of us that do have a more stable financial circumstance, many are looking to donate or make gifts to nonprofits. I know in my local community, the United Way has a relief fund with matching funds,
and we've wanted to contribute to that, as well as food shelters. While many Americans no longer do itemized deductions, where you could keep track of your IRA contributions and then get the advantage of lowering your taxes a little bit. So there's a little tiny add-on that says the additions of $300 of charitable gifts don't have to be itemized. You can just get a tax advantage right off the bat. This is called the qualified charitable contribution. Not to be confused, for those of you who have retirement accounts that are in your RMD years, required minimum distribution years, of the qualified charitable distribution, which you're still able to do even though required distributions no longer exist. So there is some expansion on charitable deductions for those who do not itemize. If you do itemize, there's also some loosening. You could give up to your adjusted gross income. Now, most people aren't probably giving the equivalent of their adjusted gross income. So if you're giving a lot, we can talk about it specifically. And nonprofits are going to be hurt as well, as their ability to operate, depending on what type of business they're in, is being impacted. So they are eligible for some of the small business possibilities about loans that we'll talk about later as well. Student loan borrowers. So student loan borrowers have payments deferred until 9/30/2020. Now, this must be a federal loan, but if you do have those federal loans, then you won't have interest accumulating during these months. And fortunately, periods do still count if you were working for a nonprofit or government entity and were eligible for loan forgiveness program. So even if you don't make that payment, if you're aiming from the loan forgiveness program, it may make sense to not be making the payments, just so over the life of the loan you pay less. And everything is subject to your personal circumstances. So you definitely want to review based on personally, not just generic advice. And there's also no involuntary debt collections occurring during this period as well. Qualified medical expenses and healthcare are also expanded. So over-the-counter medical costs, which we used to be able to count in health savings and flexible spending plans, went away recently or a couple years ago, and those are back. So you could, if you need to go buy Tylenol or acetaminophen, that would count, could be used from your flexible spending plan. Also, feminine care products are also included, which hadn't been included in the past. Medicare beneficiaries, you can get a COVID-19 vaccine when it's available, included with your Medicare benefits. If you're receiving Medicare prescriptions, then 90-day supplies are allowed right now, and there were easing of restrictions for telehealth, so fewer of us can have to get within that 6 feet, and we can keep healthcare workers, hopefully, and ourselves and our families safer with telehealth whenever possible. So we know, and we saw last week, that jobless numbers were through the roof. So you can see on the left here, this is a chart that goes back to the 1960s with unemployment claims. And typically we've been having more recently claims under 200,000 per week and or per month, and the numbers came in last week. 3.3 million people claimed unemployment last week. Wow, that's a huge number. You can see it is off the charts compared with where we've been in the past. And you can also see over here on the right how America's largest employers are responding to coronavirus. I'm going to just turn off my video for a moment so that you can see my sources as well. There we go. So the source is Just Capital. But you can see that many companies are adjusting their hours of operation. Many are laying off. Many are furloughing employees. And this is a huge impact to the American economy. So what is being done about that? Well, there are big provisions within this bill in order to maintain continuity of benefits and also to encourage employers to consider keeping their employees on the payroll, which will reduce somewhat the government burden of paying with unemployment insurance. So first of all, there's some unemployment compensation relief. That means that pandemic unemployment covers the first week of your unemployment insurance, a week that you typically would not get. And then your regular unemployment can increase by up to $600,000 per week with federal dollars through July 31st. Extensions to unemployment compensation go 13 further weeks out, depending on your state's rules of how long they can last. And then there are additional flexibility in terms of, like, if you used to be full-time and your hours have been cut to part-time, if you're a contract worker, etc. It depends on the state's rules, and it has to integrate. So I can't say that everyone will be helped, but many people more will qualify for unemployment insurance than would typically in a normal time period. So this is really important. And if you think about it, that's $600 a week on top of regular unemployment benefits. So it can be some real meaningful impact to families that are hurt, because I know so many of you have changing employment situations based on, the shutdowns that we've all had to do. There's also an element called the Paycheck Protection Program. This is targeted at small businesses, and there are business loans being offered through the Small Business Association that is coordinated with this federal program. And some of the loans are even forgivable for payroll, group health, healthcare, salaries, rent, mortgage interest, utilities, and other business interest. You have to apply for these loans by June 30th, and you can't apply for them today for the most part, because each bank is getting up and running with the new rules that are being created for these payroll protection. The amount spent in the first 8 weeks is the part that's potentially forgivable, and it's prorated based on you maintaining your employees similar to how you had them set up before all of this happened. It's really attractive though, because if you are a business owner and are doing small business loans, you know that the interest rate can be higher than, your standard mortgage. And in this case, the maximum interest rate is 4%. There's a credit for employee retention. You can defer your payment for payroll taxes as well, and you can use net operating losses more broadly. And we were thinking about how quickly you need to pay back these loans that are going to be available. You have up to 10 years to pay those back. That's the maximum. So this is intended to help out small business owners who are reeling, as well as hopefully reduce the roles of unemployed. There's also an employee retention credit. This information I pulled from the Jeffrey Levine presentation on the CARES Act about how that employee retention credit works. But if you as an employer in a small business have your revenue drop by 50% in a quarter compared with the quarter the previous year, you qualify for that credit, which is 50% of the wages of each employee, up to $10,000 of wages per person per quarter. And so you can see two different companies. You'll notice that actually Company B's annual revenue was worse than Company A's, but Company A had one quarter where they fell under that ratio of 50%, and then it's more generous in the following quarter. So this is important, an employee retention credit that can help on taxes, amounts owed. It's money right to the employer to help them keep everybody on the payroll, or as many people as possible. So I've gone over the major areas of the CARES Act that I think will help small businesses and families and employees, but there's other relief as well. So contact your creditors and anybody that you're working with, your utilities, etc., because many different entities are working, they want you to remain a customer. We can't have everybody, kind of opting out of the system at once. So there's a lot of concessions that creditors are willing to make, banks, utilities, etc. Small business associations and state and local governments and entities are also offering local relief and help. And there's delays on your tax filing as well, and some of the payments that are due that are related to taxes. So all of this is coordinating, and there are many other, different and smaller opportunities. I have a whole presentation on managing through uncertainty, which we're also going to have recorded on video. So it dovetails with the information that I provided here. So I hesitate to use the word strategies when I think about how we are addressing this with clients or people like you. A strategy is something where it's an opportunity, and we're really triaging right now and trying to make sure people are holding on to as much of their financial security as they can. But I think the number one thing to think about with the CARES Act is it gives you additional potentially triage options. There may be more money coming to you with the rebate checks, and you may have more flexibility with your decisions on how to make things work. So everybody's journey is personal, and I work with each client to make sure that we are addressing things in a way that makes the most sense for them. But I'm just so thankful that potentially there are more triage options. And then, thinking as an investor as well, I think that this stimulus gives a bridge for the economy to recover more quickly or with more stability than we would have without this stimulus. There is one area that I'm concerned about. There's a lot of obligation for state and local governments, and there's reduced ability to tax. There's less people are going to be making less money this year. So I'm concerned about state and local governments and how they're going to deal. So if there were another kind of wave of stimulus, I would be looking for them to be participants. If you're a small business, there are a lot of options right now. So you need to evaluate how to participate in relief. There certainly may be components of the CARES Act that are relevant for you. So keep that in mind and really look at what makes sense and coordinate that between your, kind of financial CFO, financial planner, your CPA, have those, your attorneys, have those conversations and act quickly to kind of get in line for relief. And for all of you, mind your 2020 taxes. So some of the options and some of the things that are changing are going to impact our taxes. And if you end up having lower taxes this year, there may be some additional planning strategies that would be relevant for you. Things that come off the top of my head are Roth IRA conversions, putting money into what is a tax-exempt account in a year. And then just in general, I think that the value of financial planning is never more seen and easy to distinguish than in a time like this where there is so much uncertainty and so much impact to people's dollars and cents. So revisit your financial plan. Don't let this time of uncertainty have you shy away from it. If you don't have a financial plan now, there's no time like the present to get started. It's not a one-time thing. It's something that you refresh over time. But so much within the fog of uncertainty, we've been relying on the financial plan for each individual client as a touchstone for how to react and respond to the changing times. I really appreciate that you took the time to join us today, and I hope you found some useful information that would apply to you. Please feel free to share this information with others. Our mission here is to help communities as they are related to people that we know in a time of uncertainty. And if I mention something where you have follow-up questions, don't hesitate to reach out. So here I have contact information, including our office, my cell phone, and then also my email. So don't hesitate to reach out. We have an office here in Dexter and also an office in Grosse Pointe. And if you go to our website, you can reach the financial advisors. Both of us are named Melissa at both offices. And thanks again for joining us. So we hope that our mission is to continue to share information like this with you. So check our website. Our blog section is constantly being updated, and we're continuously having events that relate to changing circumstances. And if you sign up for our newsletter, you'll have access to that information as it's coming out. Thanks again. Take care of yourself, stay safe and healthy. And when you have questions about your money, don't hesitate to reach out.